Initial move is higher here, and not only is it higher, that's a rip higher off the initial jump. Nasdaq's up 1.5%, 1.8%. There we go. Let's take a look and see what the print was. 2.8, guys. That is excellent.
So CPI came in lower than expected today at 2.8%, and that was good news, right? Maybe wrong. We see the S&P 500 popped on the news and has completely faded, at least at the time of recording this video, following the CPI report. And again, this was a good number. The inflation number came in lower than expected, showing that while inflation is still a little bit sticky in the US, 2.8% inflation is a lot better than 3. So we're out of the 3s, down into the 2s again, and yet that was not enough, it seems, to really get this market excited. Just goes to show the kind of market that we are living in right now. And the S&P 500's consistent pattern seems to be staying consistent. We see the pops in the morning and the drops in the afternoon. Pops up, drops down, pops up, drops down. Seems like, at least at right now, that price action pattern seems to be dominant to this market. You can see there's the CPI pop, a big pop of excitement, and completely faded, at least at the time of recording this. Now, I've been talking about on the channel that I am happy if this thing continues to go lower because I am buying some stocks that I like for the long term. So the lower it goes, the better I get discounts on. From a short-term perspective, traders on the sell side seem to be dominant on the indices, except for the Nasdaq, which is holding up a little bit better than S&P. You can see it popped really hard this morning, but again, fading that rally seems to be the theme of the indices this year. Taking a look at the dollar index, you can see CPI numbers this morning didn't really move the dollar index all that much. And the inflation numbers were soft or cooler than expected, which I think kind of just confirmed the sell-off here in the dollar index. Now, had we seen a hot inflation read, I think that the dollar could have had a very sharp up move today. But because we've already had a huge meltdown in the US dollar, I think that the market participants are kind of just saying, okay, we're good where we are. We're not moving too far one way or the other. It's kind of one of those things, the greater fool theory, etc. If everybody's already shorted the dollar or bearish the dollar, it takes a lot to keep that move going. And I think today's CPI report was cooler than expected inflation, but there's already so much bearishness in the dollar story that just wasn't enough to get this thing to break support at 103.5. That being said, the bigger picture for the dollar index to me still looks bearish, and while I think we may be due for a little bit of a bounce, I think the bigger picture is still a move lower for the dollar index as long as we continue to see cooling inflation and cooling economic data. This scenario, by the way, is actually very positive in my view for bonds, right? Bonds are, of course, trading off of yields, which yields trade off of what the Fed is likely to do next. And with cooling inflation and cooling economic data, that gives the Fed a lot more ammunition, in my opinion, to cut rates this year, right? The problem has been for bonds that inflation has been sticky, right? So that makes it hard for the Fed to really cut rates. But if inflation is cooling off and we actually see progress there, to combat the slowing economic potential growth, maybe the Fed has the ammunition to actually cut interest rates if needed. So bonds continue to look like a really good play in my personal view. I already have a long position on bonds, and if we take a look at the weekly chart, it's been choppy for some time. Will we finally see a longer term breakout for bonds above the 100 mark for TLT? I personally think so and continue to hold some of my portfolio. Taking a look at gold here, you can see we kind of have chopped sideways for a little bit in the last week or so, but the bigger picture is still an uptrend in my personal view, and cooling inflation data alongside cooling economic data still looks really attractive in terms of gold's score. And here's the latest CPI report. We've actually color-coded this in the economic heat map to show you latest data comes in orange. So if you've had a recent report, it shows up in orange. You can see there is the latest CPI year-over-year number coming in soft at 2.8% compared to the forecasted 2.9. Part of the reason I still really like gold and silver here this year is because institutional money seems to like it as well. Specifically, a lot of hedge funds still have a very net bullish positioning when it comes to gold futures contracts. You can see gold 83.5% long ratio. That is pretty huge on the commitment of traders report. And we track what institutional money is doing week to week with our software because, again, they're the ones that move the market. So if they're big, long bulls on gold, I like to keep an eye on that myself. And what we can see here is silver is also very high in that list, and the Japanese yen actually taking number three, the third place on this list. So I do still like the gold bullish story overall this year, and with cooling economic data plus cooling inflation, I really like the possibility of seeing gold break through those highs and heading up to that fabled 3,000 per ounce level. If it doesn't, I have a stop loss on the trade. The plan is to cut the trade for a loss if it breaks support that we put in earlier in the last week or so. So my plan with gold specifically in terms of managing this position that I have is, although you see a take profit level here, I'm not actually using a take profit order. My plan for this is to trail stops if the gold chart price action allows me to do so. Specifically, what I'm looking for would be a breakout through these all-time highs and a closure above that level. If we get a strong price action response to trading above the all-time highs, what I'll do is I'll take my stop loss, which is down here right now, and trail it up behind any higher low. So specifically, let's say that we get the breakout here, and then we come in and we put in a higher low at support around the 2960. I'm just saying if this happens, this is a hypothetical scenario. If this happens, what I would then do is look to take this stop loss and actually trail it in behind that higher low. So I'm looking to manage the position actively from here, but not looking to cap my upside on the position. Meaning if this chart wants to keep going off into the sunset, runs right up to 3,100, I want to stay in the trade and continue to trail stops. And this gold trade was something that I shared inside of our VIP Discord, where I share all of my trading signals. If you're interested in seeing the trades that I'm taking in real time each and every day, you can sign up using the link and promo code in the description down below. If you have any questions, you can use the first link in the description to speak directly with a member of our support team about the VIP memberships that we offer. Also, for those who are watching, we are currently doing 30% off for subscribers. You can find the subscriber discount information down below in the description. Again, just an updated view on the S&P 500. Look at that actually going from green here to red on the day. Just a consistent and frustrating pattern for the bulls out there. A little bit of good news. You would think it would go a long way, and yet sellers are taking over this candle. I mean, from a daily candle perspective, if we were to close like this, that would be pretty ugly. But we'll see. The day is still young. By the time the video's out, price could have rebounded a little bit. But really what I'm looking for on the indices, guys, is a break above some key levels of resistance, and specifically the thing that I've been talking about quite a bit is a recapture of the lost 200-day moving average. If you're watching the S&P 500, what I'd be looking for here to really kind of declare that bulls may be back in control, first of all, was not this candle. That is ugly. So we'll see how this closes today, but what I'd like to see for the bulls would be a breakout above the 5720, first of all, but second of all, I'd really like to see this 200-day moving average closed above and buyers stepping in and buying off of that area. This, to me, is the scenario that I look for in order to get short-term bullish on the S&P 500 and look for some bigger opportunities on the long side. But currently, as we stand, this is not looking super attractive, and sellers still seem very much in control of this market. Very same story could be said for the NASDAQ. If we do want to see bulls take over, we need to see this key area at 20,000 get recaptured first, and then for me also a recapture of this 20,400. This is what we need to see for me to really start to get bullish on the NASDAQ in terms of a trading perspective. Taking a look at Bitcoin on the daily chart, you can see it has been a pretty ugly chart for the last few weeks. We actually had that big update on the news that, the Trump administration would be putting into place a crypto reserve, but quickly faded. And again, subject to gravity like other risk assets is Bitcoin, it seems, recently. So for bulls here, what I think we need to see would be a breakout above this failure point to really get bulls kind of excited about this one. But right now, bears seem in control, and the next major level long-term would be to watch a break below that 72,000 level, which could put us back in the 60s. Shifting now to currencies, you can see that the euro has actually been loving this dollar weakness recently. Especially with the recent plans from the Euro region to really up their spending on the idea of defending Ukraine, as the U.S. is wobbly about how much involvement they're going to have with Ukraine going forward. There seems to be a huge kind of burst in the euro alongside this weakness in the dollar. The euro is really flying high, back up to 1.09. I think that this may have some time to cool off. We may see a little bit of pullbacks, but overall, this is one that I actually want to be more on the bullish side of on retests. The other one that I really like is the pound against the US dollar. So you can see we've had a huge breakout across that 1.28 level. If you see pullbacks into this region, I do actually like this for possible long side continuations. That's a really nice technical chart in my view, but also the fundamentals support more upside, at least at the time of recording. On the top setups page, I've also filtered for major currency pairs. And what you can see here is that we have some pretty bullish views on non-US dollar currencies. This is kind of an interesting signal we've been getting for the last few weeks, but you see dollar Swiss, dollar yen getting bearish readings, euro dollar, pound dollar. These continue to be strong signals from the edge finder. And so pullbacks look quite interesting to me. But this idea, these ones especially, pound dollar and euro dollar bullish setups for the last few weeks have been very, very good calls. Again, I'm looking to join those moves if we do get pullbacks. We spoke about Bitcoin a second ago. I want to show you guys this new chart. If you're an edge finder user, you already have access to this. It is a free update, the new Bitcoin to gold ratio. And this is a very powerful sentiment indicator. When Bitcoin is massively outperforming gold, usually the market is more of a risk on type environment. So when this chart is moving up, we would call that risk on. When this chart is moving down, we would call that risk off. This is one way to measure risk on, risk off, but basically this is saying, how is Bitcoin performing relative to gold? And what we see here is recently you have very, very sharp outperformance by gold. This thing moving lower tells you that Bitcoin is getting crushed relatively to gold. And we can see this is actually a persistent downtrend that really started in early February of this year. I think keeping an eye on this will be really powerful going forward to see if we can actually spot some, breakout moves to give us a more risk on or risk off type of sentiment vibe check, if you will. Just a reminder that if you want to check out the Edge Finder, there's also a link in the description down below. If you don't already have a copy, promo codes can also be applied. And that same discount that we're offering to the VIP memberships will honor for Edge Finder users as well. All the information, again, is in the description below. And if we take a look at value stocks here today, they're getting hit harder than the rest. You can see the Dow Jones down 0.72%. The Russell also continues to get just absolutely beaten down. But German stocks holding up decently. Here's the DAX. Here's the Nikkei. These stocks, a little bit better off than US stocks recently, although Nikkei doesn't look too much better. But take a look at Chinese stocks. The interesting thing about 2025 has been there's some ginormous disparity between foreign stock markets compared to US stock markets. You see Chinese stocks up pretty strong on the year. You have the DAX continuing to move higher, perhaps on the idea that more spending for military efforts could stimulate the economy in Europe. It's an interesting idea, that's for sure, but personally, I still like US stocks quite a bit above the rest and will be looking to add more to shares that I like inside of the group. Like I said, all trades that I share will be inside of our Discord. And today's video is sponsored by DNA Funded. If you're looking to get funded this year, check them out down below in the description and make sure to use our promo code down there for a discount as well at checkout. These guys offer up to 90% profit splits on their different account styles. You can use their 1 or 2 phase challenges, and they offer up to 800 different assets for you to trade. So you can trade a little bit of anything. Check them out, see if they're right for your trading style down below in the description. In 2022, we saw the 200-week moving average get tagged at a peak to trough drawdown. The most recent example of a bear market, we saw 27.55%. This was when the Fed was hiking rates aggressively, inflation was out of control, and things were really, really bad. I'm going to say, for the record, I don't think that is the scenario right now. I think that there's a lot of politically charged worries out there. And again, I'm not saying that as a, I'm just saying that like a lot of people are seemingly very, very much trading, investing with their politics. And I would encourage you not to do that, because I put out a tweet the other day. It's not about if you like or dislike the current administration. It's not about that. Under Biden, the markets went up a ton. Under Trump 1.0, the markets went up a ton. Markets don't go simply binary up or binary down based on if the person you like or dislike is in the White House. And if you trade and invest like that, this is not for you because you're super emotional in that state, right? You have to be able to separate your personal political beliefs from your trading approach. You can't really, in my opinion, there's going to be a lot of trouble if you're trying to make your investment and trading decisions based on if you are disgruntled or thrilled about who's in the White House. I think that's a really bad idea. Again, it doesn't matter if you like or dislike, like trade what's in front of us. And for me right now, the shift has been in the first part of the year. Part of the reason I missed, thankfully, a lot of the stock market sell-off because a lot of the data has been showing that stocks were not the same kind of risk to reward profile that were there in 2024. And again, it's not political. It's simply systematic, right? So at the turn of the year, all of this was blue. And I was super bullish and long stocks and Bitcoin. I really flipped the script when this data started turning. Now, I've missed out on big moves. I've been early to moves. I've stopped out on a bunch of stuff. So I'm not here just patting myself on the back saying I always get it right, because I don't. But again, remove your politics and stay systematic. It is so critical in a year like this. I'm telling you, there's going to be a lot of people who make up their minds that the market has to crash because they don't like Trump. And people did it in Biden too, and it was infuriating, right? They're like, oh, Biden's going to crash the market. Inflation's going to go to the moon and stocks are going to go to zero. People did that too. Don't be one of those people, because that is not how you trade and invest. You can't trade with your heart and your emotions, right? You have to trade with your brain, with your back-tested systems and strategies. Has nothing to do with if you like or dislike who's in the White House. It's just amazing that I have to spend a lot of time doing that, because I see that comment all over my channel. People are like, and people are doing it with Biden too. So it's really not, it is bipartisan foolishness on both sides of people saying, so-and-so's in the White House, they're going to crash it. I'm shorting stocks. Stupid. Don't do that. Trade with your brain, not with your emotions and politics. CPI was an important start, but will the Fed really cut rates this year? We talked a bit about that today on the Market Insights podcast. Check it out in the description down below for the full episode, but here is a quick clip from my conversation with Johnny Hart.
The big headline of the day, I suppose, is the latest US CPI number, and consumer prices have risen at the slowest pace in 4 months, so possibly offering some reprieve ahead of all the tariffs that are expected to drive costs higher. The CPI increasing 0.2%. That was after a sharp 0.5% advance in January. So, Nick, are markets reasonably pleased with these numbers?
Johnny, you would think so, and they were for just a split second. The stock market felt really nice for a whole 30 seconds, and then it completely erased those gains. I mean, more than 30 seconds, but not much longer. I mean, we really did see with the CPI report this morning, as you expressed, I mean, you would think lighter price rises would appease the stock market, especially when we break down what that means in the context of the Fed. Yesterday, Kenny and I were discussing the ramifications of what would happen if the Fed had to deal with sticky inflation plus cooling jobs data. And my reaction to the better than expected CPI report would be that should be positive for equities, and mostly stemming from the idea that, well, the Fed now has one less kind of thorn in its side, if you will, slowing it down with inflation. I mean, we can't say inflation is completely beat by any means, but at least it's not, it's broken the 3 handle. It's down in the 2s, 2.8% year over year. CPI inflation this morning forecast for 2.9. So this was, on most accounts, a better than expected number for markets. So again, we would think that this would be a positive catalyst for stocks. And it, like I said, it was for a moment in time, but this market, guys, is really interesting. It seems to be a market that is trading right now more on headlines, fears, and kind of intuition than it does on the data. I mean, the data, of course, is important as always, but this market has already shown signs of increased possibilities of a recession. And I think that the market is really seriously trading off of that, despite the data itself not really showing a whole lot of evidence for that just yet. Again, the market is very forward-looking, which in one way makes it very kind of intelligent, but at the same time, it also makes it easy to get ahead of itself, right? Maybe we're ahead of our skis here on the recession call, at least in my opinion. I think especially when we have data like today, this inflation report really helps to just give the Fed a little bit more room to sit tight, wait, and if they need to, cut rates a little bit easier. Again, I think based on our conversation yesterday, cooling inflation, if that continues to be the case, it gives the Fed way more ammunition to work with because they're not so stuck in between a rock and a hard place. If they have inflation making progress and the labor market starts to worsen, then they can cut rates a little bit easier. But if inflation's not going anywhere and jobs data starts to weaken, they're in a really tough spot. And historically, this concept of stagflation, which has been all the rave in market commentary recently, is a very rare circumstance for economists to deal with. Usually they kind of move in tandem, right? Lower inflation with weakening economic data is usually the scenario, unless you have some sort of big supply shock. And of course, we do have to keep an eye on the headlines because geopolitically, that could be a supply shock if you have some sort of escalation between Russia and all the building up of arms that seems to be going on in Europe right now to make up for possibly the lost leadership in the U.S. kind of efforts there. But again, like I said, I think the market took this as an opportunity to sell into the news, at least at this time. CPI was a good report, good news, but markets seem to be in this pattern. I've got a S&P 500 chart pulled up, selling that rally every time that it occurs. So until that pattern breaks, price seems to be continuing to lead lower. Just a quick reaction also on the dollar index, little bit of a weird one because the dollar index is largely unmoved, if anything slightly higher on a soft or cool inflation report. Possibly this could be, at least in my opinion, not a big mover just because we've had such a decline in the dollar index here recently that maybe the dollar is kind of just staying confidently where it was. Had you seen a hot CPI, perhaps the dollar would have popped pretty good on this one. But with cool inflation, I think the dollar kind of is just saying, okay, maybe this is a reasonable spot for price to sit for now, sitting at that 103.5 level on the dollar index.
Many traders don't know this, but a lot of trading profitability is dependent on you using the correct brokerage when you're trading. Remember that your trading costs are an input to your trading results. So what I mean by that is trading costs such as commissions and spreads and swaps and overnight holding things, all of that plays into your final results as a trader. And another huge thing that I cannot emphasize enough is you making a deposit into a brokerage account can earn you some significant trading perks if you use the right offer links. In the description down below, we have put together a collection of some of our partnered brokers that offer welcome bonuses when you make a deposit, free stock shares when you sign up, and access to some of our products for free. On our website, a1trading.com/brokers, that's a1trading.com/brokers, you'll see a list of free offers that you as a client to these brokers can get upon sign up and deposit. Do not make the rookie mistake of just signing up for any brokerage and not using a specific offer link. If you use our referral links, you'll get something out of it, and you'll also be supporting our work here on this YouTube channel. Thank you for watching. We'll see you next time.